Okay, welcome once again. Ouch. Okay, welcome once again. I hope I'm recording. Yes, I am. Today we would be looking into corporate governance and ethics. I wanted us to do treasury management, but I'll leave that for the last. I think corporate governance is important. So let's begin. I hope everyone can hear me.
Yes, sir.
Okay, cool. So when we talk about corporate governance, as you might have heard before, heard over and over again, corporate governance is simply the system. It's a system by which companies are directed and controlled. It's a system by which companies are directed and controlled. That's what we mean by corporate governance. Corporate governance is different from management. So if someone asks you, what is corporate management? Another person asks you, what is corporate governance or governance? There's a tendency to confuse the two. But I shouldn't confuse the two because it sounds similar, but they are not necessarily the same. So governance should not be confused with management. Governance should not be confused with management. Governance should not be confused with management. When we say management, we are looking more into how the business operations are run, how a business operation is run. So that's what it's more concerned about. That's where the concern more is. But governance is slightly different, so I thought that it's necessary for us to understand the difference. So when we say governance, you think about it this way, right? In every country, there's a governance system, right? And what the governance system does is it leads the people or the citizens, through other individuals. So let's say President Nana Akufo-Addo, right? Since he cannot manage 30 million citizens on his own, he leads them through ministers, through all kinds of people, DCs, MPs, all kinds of people. So that's how you should think about governance. Governance is about giving a lead to the company, right? What do we mean by giving a lead to the company? So what President Nana does is he gives power, authority. When he appoints you, it comes with a commensurate authority. If he appoints you as a minister, it comes with a commensurate authority to, work in the sphere for which you've been designated, right? So governance is about giving a lead to the company and then monitoring and controlling management decisions. So that's what governance means. Management will be concerned with the running of the business, but obviously, and they do that through management, but obviously there has to be a monitoring and control system put in place to monitor and control management decisions. It's very, 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 very important. Very, very important. So You see, governance takes things a step ahead. That's why in the definition, you realize that in the definition it says, is the system by which companies are directed and controlled, right? Management, they will take decisions, but who monitors and controls them? That's when governance comes in place. And the overall purpose of this is to achieve the organization's objectives. So here I say management is about making business decisions. Management is about deciding, making the decisions. Governance is about monitoring and controlling, as well as directing. So you see the difference? Management makes decisions, then governance, governance is like a control system. It's like a control measure. Put it in place so that management doesn't just do anything they want. Because management has been given the power to decide. It's the same way the minister has been given the power to make certain decisions at their level. But if there's proper governance, when we say proper governance, it means that there must be direction, there must be control, there must be monitoring. So when we say that Ghana sometimes has poor governance, people have been given authority to make decisions, but there's nothing monitoring them. There's nothing controlling their decisions. There's nothing giving them leadership and direction. So Professor Bob Tricker in 1984 put it in this way. He said, if management is about running business, then governance is about seeing that it is run properly. So now you know why they say Ghana has a poor governance, because it's not just about running the business, but ensuring that it is being run properly. That's where governance comes in. So one of the ways to understand something is to know what it's not. So I thought that since another way we can understand corporate governance, it is also helpful that, we know what it is not, basically. So corporate governance is not about management activities and skills and techniques. We said that earlier. It's more than that. It's about direction. It's about leadership. So the power... Sorry, any question? So the power of executive management to direct a business is an aspect of governance. So you see, the key word here is direct. But how they use those powers to direct business activities is not. Corporate governance is not about formulating business strategies for the company. So we are saying what corporate governance is not. Corporate governance is not about management activities, number one. That's why we distinguish from the onset between governance and management. Number two, corporate governance is not about formulating business strategies for the company. It's more than that. It's not just about that, but it's more than that. So what is corporate governance concerned with? What kind of matters is it concerned with? It's concerned with matters such as in whose interest is a company being governed? Why is governance necessary? If you look at a country, right? Why is proper governance necessary? In whose interest is it? The citizens, right? And to put in place a proper governance system, it's in the interest of owners or the shareholders, and even other stakeholders as well, right? If proper governance is in place. Number two, who has the power to make decisions for a company? Number three, for what aim or purposes are those powers used? Because we want to be sure that decisions made by management see to it that the entity is being run properly. Very, very important. In what manner are those powers used? Who else might influence the governance of a company? So, in a nutshell, this is what corporate governance is about. Any questions on this slide before I move on? Okay. Can I move on? No questions?
Sir, please move on.
Okay. So ownership versus control. The owners of a company. So one of the things I need to mention is that you cannot talk about corporate governance without talking of the principle of separating ownership from control, right? So there's a reason why in every company, ownership is separated from control. So we know that the owners of the company are its equity shareholders. Those are the owners or the shareholders, whatever you want to call them. The control of a company strategies and activities is in the hands of directors and senior management. And this usually happens in large companies. Sometimes in small companies, owners are also managers. It's very, very common. So what it means is that there is no separation between ownership and control in some small companies. But ideally, in a lot of large companies, you see that owners are different from shareholders. Now, in larger companies, however, as I already indicated, shareholders are not involved in control. Shareholders are not involved in the control of the business. They lend control to managers, to people who are professional and can manage the business. And these people are expected to give leadership to the company. And the whole idea is that they will serve the interest. Hopefully, they'll be able to serve the interest of owners. But sometimes it does not always happen. So we'll talk about that as we move on. Problems arise with corporate governance because of this separation of ownership from control. This is a basic feature of company law. So I think law is a part of, I don't know if it's a level 1 paper. Can't remember. But I think law should be somewhere, maybe level 1. One of the things you should know about companies, number one, a company is a legal entity. So what do we mean by legal entities? A legal entity means there's a legal personality. It can sue and be sued. So it exists independently of the people who own it. So a company, since it's a legal entity, you can take the company to court. You can take, I don't want to go into details of behind the veil concept and all of that. Because the company is a legal person, it can sue and be sued. So a company can sue a human being or another company. A company can also be sued. The constitution of a company usually delegates the powers to manage a company to its board of directors. The board of directors in turn delegates many of these management powers to executive managers, which we are very, very aware of. Now, the directors will act as what we call agents of the company. We've talked about this in some parts of our lectures, but corporate governance is a huge issue, so I thought that we should touch on it. So the directors will act as agents, right? And in your law note, if you remember, an agent is somebody who is contracted by a principal to perform a certain duty. Now, initially, when we were talking, we said that the whole idea of separation of ownership and control creates problems when it comes to corporate governance. And what are some of these problems? So let's look into some of these problems. What kind of problems does this whole idea of ownership and control create? Number one is that the directors of the company might be able to run the company in a way that is not in the best interest of the shareholders. Now, you need to understand that owners have their own interests. When we are doing stakeholder analysis, we realize that every stakeholder has their own interest. Every stakeholder has their own interest. That's what you should know, right? Every single stakeholder has their own interest. So directors will have their interests, shareholders will also have their interests. And sometimes it's possible for directors not to act, in the interest of shareholders. So that's one problem. And the second problem is that since the owners do not have managerial powers, right, they might not be able to prevent the directors from doing that, from acting in their own interests fully, because they've given the managerial powers to these directors, to control what the company does. So that's also another problem, right? Because there's this segregation of powers, it might be difficult for the owner to prevent, to a large extent, directors acting in their own interest. Now, when the shareholders of a company are also its directors, like we saw in, I think when we are analyzing one of the pre-seen materials, we saw something similar like that. When the shareholders of a company are also its directors, in that case, it means that there's no separation between ownership and control. And in such situations, problems associated with corporate governance are less likely to arise. Let me repeat that again. When shareholders of a company are the same as the directors, it means that there is no separation of ownership from control. In such situations, problems with corporate governance are less likely to arise. Now, another thing that complicates the problem a lot, another thing that goes on and complicates this whole separation of ownership and control thing is that when the company has different shareholders and there's no majority shareholder, that also complicates the problem. It complicates the problem in the sense that since no one is the majority shareholder, right? Since no one is the majority shareholder, literally no one can rally a cause to get management to act in the best interests of the company or best interest of shareholders, because no one is like a lead shareholder. The more you have invested into a company, the more powerful your voting rights and the more powerful your influence in the company. If there's nothing like that, then it complicates the whole problem. And I said, in these companies, the board of directors have extensive powers for controlling the company, but the shareholders are relatively weak. So you see, because there's no lead shareholders or majority shareholders, it makes the shareholders weak. Like if people are owning 2%, 2%, 2%, and a lot of shareholders, there's no one owning like 20%, 30%. Everybody's owning a little piece, and no one is really standing out. One, it's difficult to come as a unified force in that case. And two, there's no majority shareholder in that case. And so the shareholders would be relatively weak compared to the board of directors. Now, the directors have to be accountable to the shareholders for the way they are running the company. However, in practice, the shareholders might have little or no influence and do not have the ability to prevent directors from running the company in the way that directors themselves consider to be best. So this is what we talked about earlier. Any questions on this? Okay. It seems there are no questions. Now let's look at ownership and control in non-corporate entities. Ownership and control in non-corporate entities. Sorry. Ownership and control in non-corporate entities. The separation of ownership from control can affect the quality of governance in non-corporate entities as well as companies. Right? In an entity, it should be possible to identify owners and controllers. The owners might be the government or the public. In the case of like a charity organization, the owners might be a section of the public. So we are looking at different entities who are not necessarily corporate here. We're looking at things like charity and all those kind of institutions. So in such bodies or such non-corporate entities, those in control will be given the power to govern that non-corporate body through what we call a management committee. Management committee. I think if you ever watched what do you call it? In Ghana, there used to be it's not like a TV show, but GTV at a point the government was doing like a corruption investigation, right?
PAC.
What's it called?
PAC, Public Accounts Committee.
Public Accounts Committee. That's true. PAC. So you see, they'll call maybe the management committee members of maybe GFA. Then they'll show up. The management committee. So that's the system that is used in that case. So appointments to the management committee might be made by the owners or by means of a procedure that is specified by the constitutional rules. So in Ghana, you have the constitution specifies, okay, who appoints. I don't know who appoints the GFA management committee. I can't remember. I used to follow sports a lot, but I can't remember who. Maybe, I don't know I don't think it's the president, maybe the sports minister. Somebody does that. So it's important to understand that the dynamic, right? When it's a non-corporate body, the principle remains the same, but the dynamic is quite a little slightly different. That's all I wanted to point out. Now let's look at some laws and guidelines related to corporate governance. It is well recognized that there is good governance and there is bad governance, right? So in your own words, from what you've discussed, what do you think is good governance? What do you think is bad governance? Good governance will be, in simple terms, when, there's no monitoring and control of management decisions. Sorry, bad governance will be when there's no proper monitoring and control of management decisions. Good governance would be, the opposite. But here, bad governance occurs when an entity is governed in a way that is inconsistent with certain concepts and practices. So what are these practices? Or what exactly are we talking about here? Often, bad governance means that a company is governed in the interest of directors rather than the interest of owners. You see, that's why governance is important. That's why governance is important. So let's bring this home to our country, Ghana. What is bad governance? It is where the country is run in the interest of the leaders rather than the citizens. So that's what we call bad governance. It's when you are running the company in the interest of the directors. It's the managers that are looking for their interest instead of the interest of the owners. Good governance is the opposite. Now we'll be talking about directors. Who are these directors? Who are these directors? Okay, let's talk about them first before we even go to good governance. Who are these directors? And who are they in the company? To some extent, good governance is supported by the law. The law supports good governance. In Ghana, for example, the directors of a company owe certain duties to their company. They owe certain duties to their company. And these duties are stated in the Companies Act. So what does the Companies Act say? A director shall act at all times in what he believes to be, the best interest of the company as a whole, so as to preserve its assets, further its business, and promote the purposes for which it was formed, and in such manner as a faithful, diligent, careful, and ordinary skillful director would act in the circumstances. So even the Companies Act, Act 179, is saying that directors should act in the interest of the company and not in their own interest. And this is the expectation of anyone who is this is the expectation of anyone who is a proper director. Then it goes on to state that in considering whether a particular transaction or course of action is in the best interest of the company as a whole, a director may have regard to the interest of the employees as well as the members. Members here referring to the owners of the company. So, the whole thing about interest, acting in the interest. So the act also, this same act also, so you see how the Companies Act talks a lot about directors' duties and their interests for the company. As you are going through your pre-same material, as you are going through your case study, you have to look out for corporate governance issues. That's why I'm taking the pains to go through. I wanted to do treasury management today, but I was like, let's hold on to that for maybe next week. So as you are going through your case, think about corporate governance issues. Think about corporate governance issues, please. Okay, goes on to state, in considering whether a particular, I've already read that. The Act also requires the directors of a company to present an annual report and account to the shareholders. This help makes directors accountable. So you see, there's also a requirement here that they're supposed to present annual reports. Now we've talked about let's talk about directors' powers. The powers of a director. The powers of a director. Section 137 of the Act states that except as otherwise provided in the company's regulations, the business of the company shall be managed by the board of directors. Shall be managed by the board of directors. Very, very important. Who may exercise all such powers of the company as are not required to be exercised by the members in general meeting. In addition, the board can exercise its powers through committee and can appoint a management director with delegated powers of management. So what are we saying here? We're saying that businesses are managed by the board of directors, but the board of directors can also manage a company or an entity, either through a committee, either through a management team, either through a managing director, sorry. So that's also a way to look at it. Now we talked about bad governance in our previous slide. So what is good governance? Good governance. A well-governed company is one in which the board acts in the best interest of shareholders. The board acts in the best interests of shareholders. The board is acting in the best interest of shareholders. The reason I'm repeating this over and over is so that it sticks at the back of your mind. So when you are going through your case and you are seeing that somebody is in the business for their own interests, then you know that there's a corporate governance issue. That's how you're able to predict the questions that will come. It doesn't always follow 100%, but you can tell as you go through the questions, you can see that, oh, this will happen, this will happen. The pre-scene, you can tell that this will happen. This is likely to be asked. So a well-governed company is one in which the board acts in the best interest of shareholders and other stakeholders in accordance with the law. In doing so, a board should apply a number of broad concepts. Failure to apply these concepts is likely to mean bad governance. So what are some of these concepts? The concepts that we know. These are things that we all know. Number one is fairness. Number one is fairness. And when we talk about fairness, what exactly do we mean? Owners should receive fair treatment from directors. So it means that owners should have 1 vote per share. So if you have 1 share, you have 1 vote. That's fair treatment. And you should be given, equal dividend per share. It's not like somebody have 100 dividends for their share and you receive $6 dividend. So it's not like somebody received $100 dividend, another person receives 6. Similar dividend per share, same dividend per share, and same votes per share. You also have transparency. Transparency. You have to be open and transparent. The intention should be clear as management. Intentions should be clear. You have independence. Independence. What does it mean to be independent? It means you are free from the influence of someone else. So directors have to be independent, which means they're able to make decisions on their own. They're able to make decisions on their own. Let me correct this real quick. They're able to make decisions on their own. Okay. Now, honesty and integrity. We all know that honesty, self-explanatory, right? Self-explanatory. There must be honesty. It's a concept of good governance. There must also be responsibility and accountability. When you are given a responsibility, the directors of a company are given most of the powers for running the company, right? When you're given a responsibility, also means that you should be accountable, And that's where when management is given a responsibility, they're also made accountable by providing annual reports. It's very, very, very important. Very, very important. Then you have reputation. Reputation. One of the things that good corporate governance does is it reflects on the outside. So if a company is managed properly, it's likely to have a good reputation. Now let's talk about some of the principles and guidelines. Let's talk about some of the principles and guidelines when it comes to corporate governance. Any questions so far? I should have asked, sorry. Just moving. Do we have any questions? Any questions for me? Okay, looks like everything is understandable. Now, the law includes some provisions that promote good corporate governance. The law has such things in place. They have certain principles that promote good governance. However, there are many principles or guidelines for good governance that are not supported by laws or regulations, but they may be set out in what we call a code of corporate governance. So a lot of countries have different codes, but we will focus on Ghana. I don't know if we will get to the OECD principles today, but Ghana's code is largely based on the OECD principles of corporate governance and the Commonwealth Associates for Corporate Governance principles. That's the foundation for Ghana's code. Now, the codes of corporate governance are directed at large public companies with a large number of shareholders. And again, Ghana has a code of best practices in corporate governance, which is an optional code designed for companies with a stock market listing, so public companies. This is an optional code. Again, let me repeat, this is an optional code. It has a code of best practices. And this code is like a guideline, it's like a guideline, and it is not legally enforceable. That's why we said it's an optional code. And the expectation is that listed companies or public companies will apply these guidelines in this code. It is basically a best practices document when it comes to corporate governance. That's it. Okay. Sorry. Okay, so there are some key issues in corporate governance. And these issues define how well or how terrible a company is governed. So the main areas, we need to know the main areas. So I'll say this slide is very, very important. That's how you identify corporate governance issues, right? The main areas covered by codes of corporate governance are as follows. Number one, the role and responsibilities of the board of directors. The role and responsibilities of the board of directors. Very, very important. The role and responsibilities of the board of directors. Now, the board of directors should have a clear understanding of its responsibilities. And so good corporate governance or governance would ensure that the board of directors' responsibilities are established properly. They're established properly. So